Hi, this is Hutch, and today we're going to talk about a way to use the Terra ecosystem to hedge against systematic risk. And what I have up here is a chart of the S&P 500. It actually goes all the way back. You can see 2007 way back here, 2008. And even though this looks like a little bit of a hiccup, we can see that the S&P was at 1,500, almost 1,600, and it fell to 7 before we melted up. And I love this saying, stocks take the stairs up and they take the window down. They take the stairs up and they take the window down. They crash usually a lot quicker than they melt up. And you can see this parabolic run since then probably has something to do, like 30 trillion things to do with the amount of stimulus we pumped into the economy. And a lot of you are overexposed to this risk, whether it be in your 401k, maybe you have brokerage accounts where you just have so much embedded tax, you just don't want to cash these things out. Or even if you're all in on crypto, to think that we could have some kind of major cataclysmic event like that and not have crypto be affected is a little bit complacent. Even if crypto were to reemerge as the winner, as the phoenix rising from the ashes, to think that there wouldn't be a crash, I think is foolish. And so this strategy that I'm going to share with you helps hedge against that risk in a way that's buffered by the robust yield you can get on stablecoins in the Terra ecosystem, earning currently the 19.48% simply by depositing your UST. So traditionally, if you were to short the S&P 500 in any way, shape, or form, really you're just kind of picking a line in the sand. You're like, I think this is where it ends, and if it goes up, if it just keeps spiking, this is not a melt up. This is a melt up. This is a spike up. If it keeps spiking up, you get wrecked. If it goes down, you make money. And if it stays flat, you actually traditionally, when you're borrowing to short something, you're at least paying to borrow, or there's an opportunity cost. And what's unique about the Terra ecosystem is we can use this 19% from Anchor to mitigate losses if the S&P were to continue melting upwards. If it stays flat, we continue to earn our 19%. And obviously, if it goes down, we'd have a huge windfall. So it's a very unique opportunity and really where TradFi and DeFi intersect or may intersect to produce a good result for you. I don't want to claim to have all the answers. This is experimental. I really just thought of it, and I do want to give credit. I was inspired by a strategy I originally saw from Clean Cuts, a fellow lunatic who seems to be very, very creative, because I've seen lots of degen strategies involved with Anchor Borrow, and he just totally went a different direction using aUST and mirror short tactics to produce a similar result. He has a video here about how to turn any M asset into free Luna. I believe he was piggybacking off of Lunanomics' leverage longs, just parking Luna and borrowing against Anchor to get more Luna, which has obviously worked quite well for him and very well could continue to work well for a long time. If you're not following him, you should. He's also has, in his pinned tweets, he has a whole Google Doc full of basically explaining the entire strategy, and is doing an ongoing Terra Spaces course, which is like a live podcast that you can follow. And if you're watching this way out in time, you can go to terraspaces.org, and they're recording everything for free. Don't forget to tip them. They're doing so much for the community. Their address is down here. And last but not least, Rebel DeFi, who actually gives props to Dr. Clean, who came up with this strategy months ago. Unlike Clean Cuts, who was looping the M assets to go ahead and get more Luna, Rebel is doing it to really just juice up the yield on stablecoins, which I realize a lot of people will feel comfortable with. What's nice is this video, Rebel's video, is done on desktop. Clean Cuts is done on mobile. So I find it good to watch both just to understand the complexity of the multiple loops. So let's go ahead and get into this variation where we're doing this to hedge against systematic market risk. In fact, if we go to the Clean Cuts Terra Degen Stable Farm Strategy Medium article, you'll see this is what he likes about it. He says in his video he likes to deposit on Anchor and be on that side of the ledger rather than being a borrower because he can't really control the borrowing rate and it's algorithmic. And this was very, very interesting to me. Mirror allows interest-free loans backed by aUST, which means you get to deposit and earn the 19% and then use your depository token, right, to borrow on Mirror interest-free, and you only pay a 1.5% protocol fee, and that's to close the position. And so what's nice is, people who are worried about what's going to happen to the the Anchor borrow rate, what happens when they run out of Anchor tokens, what happens if the yield reserve goes down. Well, at least for those that are concerned about that side of the ledger, borrowing in this way, it's a fixed 1.5% to close out the position, regardless of how long you hold it. And on the other side of the ledger, you continue earning whatever Anchor pays on the earn side for your collateral to borrow against these assets. So skipping ahead, how to execute the strategy, you go to the Mirror. He recommends going to the farm page. We're not going to do farms because there's really no farm yields on the S&P. But if we just go to the next steps, start capital. We will deposit UST and Anchor. Now remember, this could come straight from dollar cost averaging and just putting UST on, or it could be borrowing UST against your Luna and then depositing that on Anchor for another bite of the apple. And that reminds me, Clean's got the Terra origami strategy where he talks about lots of folds. That's yet another fold. That's a pretty cool article if you want to read it. I think that's the original that inspired this. So first, we will borrow or short farm. We're not going to short farm. We're just going to borrow our chosen M asset. In this case, we're going to do SPY and not SLV like he does in his video. So if you watch his video, replace SLV with SPY. Our chosen M asset against aUST with Mirror. Remember, our goal is not to speculate the asset, the synthetic asset. Forget this because he's talking about the premiums. And in fact, let me just show you. I'll just show you guys what we're talking about. So, oops. Oh no, I'm sorry. Trade. So if we look at the premium of SLV, it's trading at 5% above premium. So when he shorts, part of the reason why he likes SLV is he shorts it and then he sells it right away. And so he picks up like an extra 4 something, almost 5% when he's looping it. And you'll see there's not a lot of premium with the S&P. And also he talks about short farming as an option. With SLV, at least you can earn an extra 13% on top of the 19 for short farming it. With SPY, you're only going to earn 0.73. So forget that. We're just going to do the straight borrow if we go to the SPY. And the gem of it that he talks about in his article is we have to choose a collateral asset because we're going to borrow mSPY. And as soon as we borrow it, we're going to sell it short. But if we want to borrow an M asset, we can use aUST. We can use UST, but then we won't earn the 19%. We're basically taking the UST out of Anchor, not earning the 19%. And we're using this as we're parking it as collateral here and not earning. Well, why do that? We can leave our UST earning 19%, use aUST, which is basically just a depository token. We're only going to get about 85, 86 cents on the dollar, but still, we're just parking it as collateral while it's earning over there. Again, another fold of that Dr. Clean origami. So once we do that, just like with Anchor borrow, there's a point at which we get liquidated. In the case of S&P, it's below 130. Yet another reason I like that. If we look at SLV, if you get below 150% collateral, you get liquidated. I guess they deem the S&P as not as volatile. Well, it is until it isn't. Or it isn't until it is, I guess I should say. But I recommend staying well above safe. And think about it. In order to do this, all you need to do is park more aUST. Well, for those of you that just love that stablecoin yield, all of this is potentially getting another bite of the apple. So what difference does it make if you're earning 9% or 19%, whether you park 180% of the collateral of what you're borrowing, or you're parking 265% of what you're borrowing if you love the 19% and you don't want to do other things with it. Regardless, I recommend that you live in this area, not in this area. And certainly if you get to this area, you're wrecked. And again, the other reason why Clean Cuts likes this, is instead of the anchor borrow, percentage where, hey, it's been kind of pretty even. Sometimes you're a little ahead, sometimes you're a little behind because of the anchor token, and that may disappear someday and nobody knows what the true borrowing rate will be. Here, there's no borrowing rate. It's just a fixed 1.5% fee to close this entire position out, regardless of how long you hold it, which is pretty cool. So what's next? We borrowed the S&P. We talked about how to manage that. But if you've chosen to borrow, you may immediately sell the M asset for UST. That's how you short something. If we just borrow to buy the SPY, mSPY, we're technically long. We actually need to sell it. So what we need to do is go to either TerraSwap or Astroport. So this is new. You won't see the Astroport on the Rebel video or the Clean Cuts video. We'll sign our life away. So you would find the mSPY. They don't have it yet. I assume they will at some point, but they don't have it yet. Let's see, TerraSwap does. There's mSPY, and we're going to sell that. We're going to provide that, and we want UST. So we're going to swap mSPY for UST. I don't have any, so it's not going to show me the ratio, but essentially we're going to sell it and we're going to get the market price. So if we go here to mSPY, you have to do this during market hours too. But assuming the market was open right now, we could get 475 for it. So we're going to sell it. And this is, I think, part of the reason why Clean Cuts likes silver or mSLV is because you got a premium. So when you borrowed to get it, it was worth 5% more than what the actual Oracle, or the Oracle price is worth 5% more than what it's actually worth. So you would sell it and you get this extra value. And that's going to come in handy with the next steps, which is looping. So we're going to sell it and then we're going to deposit the UST right back into our anchor. So we're going to sell it, and then we're just going to say we're going to take the money. So we parked aUST, we borrowed SPY, we sold it, and when we got the value back, we're going to park it in here to earn the 19%. And then guess what we're going to do next? Yep, we're going to loop it. We're going to take what aUST is possible, and it's not. You can only do this so many times. You can only loop it so many times because remember, you only get about 80. Well, let's just look. So if we change this to aUST, right? So aUST, we don't have that. Let's just change that. Let's see. There we go. Let's put 1 UST and see what that's worth in terms of aUST. You don't get dollar for dollar. So you get 86 cents on the dollar of aUST. So you can only loop it so many times. But if we look at his thing, second borrow, we will deposit the aUST in a mirror protocol and borrow or short farm again. We're just going to borrow. And then we're going to sell the borrowed asset for UST and wait for, well, that's short farm. So then we're going to deposit the UST into Anchor Earn. And he just goes on. Third borrow, fourth deposit, fifth borrow. 6th deposit, 6th borrow. So you can do this as many times as you're comfortable with. I agree with him that there's not as much risk per se as with the anchor loan because then you have a loan accruing against you. With this, you don't have to worry about a loan accruing against you. What you have to worry about is this price going against you. So I think what you want to do is you can, if you have infinite number of funds or you have really strong income that you can continue to DCA to dollar cost average UST into the strategy, you can loop it till the max so there's just no more room. But if you don't, you may want to leave yourself a little bit of room to run. And instead of looping it however many times he did it, let's see, 6 borrow and then final deposit. So I guess that's a 7th. So whatever, 5 or 6 times, you may only want to go 3 or 4 times and leave a little gas in the tank so that if the S&P does continue to run up, we talked about how much room you had, but we'll just show it again here. So if the S&P is at 4778.74 and we multiply that times 1.19, so we're at the end of the year here. It needs to get to 5686. So this is 50, and this stupid little UST thing's in the way. Yeah, that's 5,200 right above it. This is 5,200. So it needs to go from 48 to 50, 50 to 52, 52 to 54, 56. It needs to be here to really outrun the 19% of room that your aUST is going to naturally just kind of work in your favor. And what that means is if we go back to mirror, it should, let's just say the S&P stayed the same. Your collateral rate should continue to creep up because this aUST appreciates in value because that 86 cents moves closer to $1 over time. So that should happen. But I do recommend leaving some aUST in the tank so that if they pump out more stimulus or there's a good jobs report or whatever would make the S&P go up, you have room to, I'm sorry, it would go that way. If the S&P is going up and your bar is going like this, meaning you have less loan to value, you can deposit more aUST and get back into a safe zone, which I recommend really between 200 and 300%. You're not going to get liquidated to 130, but that's what I recommend. So again, the looping strategy is probably, I went through it very quickly. I recommend you watch not only Clean Cut's video, but also Rebel's video because they both go over this strategy with silver. The same concept, just replace SPY with silver and understand there's not going to be as much premium, so you won't get quite as much juice when you sell it and loop it. But you're going to have room for 3, 4, 5 loops probably pretty safely. I wouldn't go pedal to the metal, though, unless you have money on the sidelines that you can manage the position. And speaking of managing the position or whether you're using this to enter, I wanted to talk about, again, the intersection of TradFi and DeFi, how to maybe get some money from an area where maybe you're already overexposed to the S&P 500. And maybe you can't withdraw from your 401k because there's taxes or there's penalties. If you're actively working, though, you can do a 401k loan. And I pulled this little JPEG up from Investopedia. So you can borrow up to $50,000 or 50%, whichever is less. So that's a lot of money. And when you borrow from, not against, when you borrow from your 401k, they're actually pulling the money out of the investments. And as we saw, we're at record highs. We could go higher, but basically what you're doing is you're divesting from the market at its all-time high or near it, and you're reallocating to crypto, or perhaps even this strategy where you have some exposure the other way and make money sideways. So you need to be aware that you are going to need to pay back principal and interest. So it's usually tied to prime, which is around 3%. Some 401k providers charge more. You need to contact your HR. And this is, I found this to be rare, but you won't be permitted to contribute further. You usually can, but I'm not sure. You may still want to, and you need to see if your cash flow is worthwhile. Some companies may not even allow it. And this is probably the most important part. You need to know that this is a 5-year window or whenever you get fired, whichever happens sooner. So the loan you take against a 401k, what's nice is 5 years traditionally doesn't seem like a lot of time, but most of us believe that in 5 years, crypto investments will do quite well. So this gives you a little bit of runway in case we go through a little bear market for a little while or a little chop. It gives you enough runway as long as you can support the principal and interest payments for this $50,000 loan or whatever 50% of your account value is, plus prime. As long as you can do that, now this frees up capital to do the strategy we're talking about, invest in crypto, or maybe to do the strategy we're talking about, and you leave a little gas in the tank. Like you borrow the whole thing and you just kind of put it there, you put it in an anchor earn, and it's there to go ahead and add more collateral if needed. So you have that. The other thing is not everybody has money in 401ks. Oops, nope, not that. I wanted to show the margin. Oh, I know where it is. The Interactive Brokers margin loans. So Interactive Brokers, like a lot of people have Schwab, TD Ameritrade, Fidelity. You know, these margin rates aren't really actionable. Robinhood's only $250, and I have used that, and a lot of people already have Robinhood. You have to pay like a $5 fee every month to be part of it. but then you can borrow at 250. And what's nice about margin is since it's borrowing against investments, taxable investments, this is deductible. So if you're working and say you're in the 40% tax bracket, well, really this feels like a 1.5% loan because you're getting essentially 1% back as a deduction on your taxes. 40% of 250 is 1. You can roll your positions. So without cashing out your positions, if you had money in any of these, you could roll them over to Interactive Brokers. I would recommend Pro, and you can borrow at 1.55%. That's actually on the high end. Actually, let's look at this. If you type in Interactive Brokers margin rates and click down here past the ads, margin rates and financing, they got a handy dandy calculator. Again, I go with the Pro, and all the Pro means is you have to pay commission on trades. If you're just rolling over assets you already have, then you don't have to. But you have to, when you pay commission on trades, they actually brag that they have best execution. I've found that to be true, meaning they route it to all the different possible market makers to get you the best execution versus all the other ones we talked about. They've been criticized for paying for order flow and not getting you the best fills. But you are going to have to pay a half a penny per share for your trades, or essentially $1 for up to 200 shares, which is nothing. And for doing that, you can see if you have a loan less than $100,000, you're going to get charged 1.58. Again, if that's deductible and you're at the 40% rate, your net cost to borrow is now under 1%, which is pretty good. I realize it's not as good as Anchor, where it's positive a lot of times, but we're talking about assets that maybe you have a lot of taxable gains, or you've had them for a long time, they're paying dividends, you like them, and you just want to. It's almost like borrowing against the Luna. If you believe that, like, you have, say, like Apple stock, CVS, none of this is investment advice, but just stuff you really believe in, you could borrow a safe loan to value amount. You can borrow against that and have $1 wearing multiple hats at a low cost. From 100,000 to $1 million, it's actually the second 100,000. So the first 100,000, you're always going to pay this rate, and the second 100,000 all the way up to $1 million, 0.108. And if you're a whale, 0.75 for that tier, and you can use this little calculator to figure it out. But we're talking a very low cost to borrow. The other thing I was going to bring up is something called portfolio margin. So you have to have a balance over 100,000, but if you do, typically margin, like on Robinhood, or if you have a smaller account on IB, they're only going to let you borrow 50% loan to value. And I don't recommend that you take it up to 50. That's like taking your Anchor loan right up to 50, and you're going to get, actually, it's like taking it up to 59 with Anchor, where you get liquidated at 60. You don't want to do that. You want to leave yourself some room. So if you're using Reg T margin, which is that 50%, the traditional margin, it's called Regulation T or Reg T on Robinhood or a small account on Interactive Brokers, and you can only borrow 50%, I'm going to recommend that you stay in like the 20-25%, because if you do that and stocks lose half of their value, which we saw they do, then you're still probably not going to get liquidated. You can go a little bit higher as long as you can manage the loan, which means when stocks are falling, you can either add more stocks if you have them in other accounts. It's going to take a little time, or you can add cash. And what I can tell you about Interactive Brokers is it's very easy to link your account to where you link your checking account, and you can get money on there within 24 hours and out. No fee with ACH. It's very, very convenient. Robinhood seems to take about 3 to 5 days, so I don't like it as much as Interactive Brokers. Plus, it's a lot lower rate. Going back to portfolio margin, if you have over $100,000 account, portfolio margin isn't really a percentage. Like, I can't say it's 70% or 80% or 90. Sometimes it could actually be, close to 100. It has to do with volatility. It's kind of like the Anchor algorithm. Like, nobody really knows what it's going to be, but it's based on volatility. So a strategy that I do, because I use portfolio margin, is I like to have a makeup of different assets. I might have some kind of blue chip-ish stocks, some tech stocks, but even those are pretty correlated. I do paper gold, like IAU or SGOL, not investment advice. SGOL I found to be the cheapest way to have paper exposure to physical gold. It's not the same, but since you have money on here and it's liquid, I can borrow against it, unlike real physical gold, which is hard to transport, it's hard to store, and I can't borrow against it. I maintain exposure to paper gold. And to me, it's not really a stable coin, but it feels that way sometimes. And there's a little volatility. But at least when stocks go down, sometimes gold goes down a little bit because people are like, sell, sell, sell. But then they usually kind of counterbalance each other. And then more recently, I've added in some crypto plays where I have exposure to crypto type stocks. And so it's really like I have three different, not totally correlated buckets. Because the portfolio margin algorithm is looking at volatility, I'm hoping that not all of these things will be volatile at the same time. I've done things like selling puts on things like GLD, which is gold, where it's like, hey, even if it goes down, I'll put the stock, and that puts cash or income in there. I've done covered calls. I've actually done that on things like Coinbase stock and SI, which is another crypto stock. And unfortunately, it shot right up through the call and it got called away from me, but I made a profit on the stock and I got income. You can do those things with this type of account and borrow against it at very favorable rates. And depending on how big your account is, you can use a fair amount of leverage, but with caution, just like you would with borrowing against Luna. Risk or leverage always amplifies risk, so do your own research and be careful. I do want to say there's a link if you sign up with Interactive Brokers with me. There's a link where you can get up to $1,000 IB stock. I think I get $200 if you sign up with my link, and depending on how much your account is, it caps out at $100. If you put in $100,000, you'll get $1,000 worth of Interactive Broker stock, and I think I had. This is like all-time Interactive Broker stocks. You get $1,000 worth. You could use it like a farm token where you get it and sell it right away. You can keep it, whatever you want to do. But it's like dollar for dollar. Every $100 your account is worth, even if you just transfer stocks, you get $1 worth of stock, capping you out at $1,000 worth of stock for $100,000. So pretty cool. So the main takeaway I want everybody to come away with is the fact that even though these dips look like little minor blips on the screen, they are, because it's a 13-year time frame. But the fact of the matter is, when the S&P has dropped 50% or 20% or 30%, it sends cascading liquidations around the globe. We're all attached to the hip. Diversification is a thing of the past because the world has gotten smaller, and crypto is looped in there. So you're not totally immune to this. And what's unique to Terra and its stablecoin system is perhaps this is a way to not only hedge against that risk, but to be able to earn a stable yield that isn't totally risk averse, in that if the S&P continues to go up, that can erode your 19%. But you have room to be wrong to the upside. If we chop around sideways, it's a way to make money. And if things go down, that creates a potential windfall. And this is especially important if you're allocated heavily to the S&P, or S&P funds in drag in your 401k, or your stocks that make up the S&P in your taxable brokerage, or even if you're all in on crypto. To think that the S&P could crash and you're not going to be affected is a little bit complacent. So this is meant to be an open collaboration. I don't know for sure if this strategy works, but I wanted to take my knowledge from TradFi and blend it with the unique tools we have available on DeFi and petition you guys to say, am I onto something here? Where are the holes? Please tell me. So comment below and let me know what you guys think. All right. Talk to you soon.